Hello everyone, this is CMA Swarupa Vishwanathan and welcome to my channel. So today we are going to see a question on partnership accounting with respect to the retirement aspect. So in the previous video, we have already covered the admission aspect. So if you have not watched the video, the link is there in the description. You can check out the video and do subscribe to our channel because we are going to have a lot of insightful contents for CMA exam preparation. And if you like this video, don't forget to like and share. Now, coming to this particular question, I've taken a question on retirement accounting, which is there in the study material. But we are going to see the end to end of how to approach that question. You get a question on partnership accounting, retirement, 14-mark question. How are you going to approach? What are the steps that you should remember so that you don't miss out on anything? So the first step in retirement is to identify your old profit sharing ratio, the new profit sharing ratio, and the gaining ratio. So gaining ratio, in case of admission, it was sacrificing ratio because one person coming inside the partnership, the existing partners, they tend to lose a share of profit. So there is a sacrificing ratio. In case of a retirement where one of the existing partner, if there are three partners and if one partner is retiring, we are left with only two partners. So if the earlier profit sharing was 1/3, 1/3, 1/3, now it is 1/2. So the existing partners are gaining because of this one partner going out of the partnership. So we need to find out the gaining ratio. Gaining ratio is new profit sharing ratio minus the old profit sharing ratio. So from this question, it is given that A, B, C are sharing profit in proportion of their capital. So the old profit sharing ratio is 4:3:2. Now we want the new profit sharing ratio. Step 2. New profit sharing ratio, you can, if you see question number, the point 5 in this question, A and C are going to share future profits in the ratio 5:3. So we have the new profit sharing ratio also given in the question. So we need to find out the gaining ratio. Gaining ratio is new profit sharing minus old profit sharing ratio for A and C. That is 5/8 minus 4/9, 3/8 minus 3/9. So once we solve this equation, we get 13:3 to be the to be the gaining ratio. Now the next step. So once gaining ratio is found out, the next step is to identify goodwill reserve adjustment. You will have goodwill adjustment and adjustment for reserves. So we are going and seeing where is the goodwill adjustment. Goodwill of the entire firm is fixed at 21,600. So for the total firm, the goodwill is 21,600. In this 21,600, B's share is to be adjusted into the account of A and C in their who are going to share the profits in 5:3. So we are going to do an adjustment through the capital account. Goodwill adjustment is going to be done through the capital account. So we need to see what is the share of goodwill of B. B's share is 3/9. So 3/9 of 21,600. You get 7,200 to be the B's share. Now this 7,200 will be given to Mr. B by A and C who are gaining because of his retirement in the ratio of the gaining, that is 13:3. So 7,200 into 13/16. Then 7,200 into 3/16. So we get the adjusted amount. So what is going to be the entry? Entry will be A capital account debit, C capital account debit to B. We are going to pay B. A and C are going to pay B 7,200. Okay. So this goodwill part is done. Reserves. Next we have to check if there are any reserves. There are no reserves. So we'll go to the next step. The next step is to prepare a revaluation account. So I'll just mention here the step 4 is it will be goodwill and reserve adjustment. Now step 5, we come to step 5 which is revaluation account. We have the details given. Stock is depreciated by 6%. There is a provision to be created. Land is appreciated. So we have 1 to 4 relates to all the revaluation entries. But you need to see the point number 6 here. Assets and liabilities are to appear in the balance sheets at their old figures. So that means that once you prepare revaluation account, what will happen generally? The profit or loss will be shared among the partners in their old profit sharing ratio. And when you prepare the balance sheet, you will use the revalued figures. But in this question, it is stated that you should not use the revalued figures. Use the same figures as that of the old balance sheet. So in that case, we should not prepare a revaluation account. Instead, we have to prepare a memorandum revaluation account. Okay. Because we are just going to adjust the profit or loss on account of revaluation is going to be adjusted through the capital account of the partners. Okay. Without affecting the assets. That is what is going to happen. So first one, stock. Stock is depreciated by 6%. So I'm just taking the data from the balance sheet. So stock is 16,000 into 6%. It is depreciated. So we need to reduce the value of the stock. How to reduce stock is a asset account. If you debit that account, the value will increase. If you credit an asset account, the value is going to decrease. So in this case, what is the entry? Memorandum revaluation account debit to stock account. So you're crediting the stock account. So when you are crediting an asset account, the value is going to decrease. Provision for doubtful debts to be brought up to 5%. So now if you see, it is only 2%. 10,200 is the provision. We need to bring it to 5%. So additionally, we need to create a provision for 300 rupees. When you create a provision is a liability account. If you credit a liability account, the volume will increase. So what is the entry here? Memorandum revaluation account to provision. So that you are crediting provision account, the value is increasing. So here it is to provision 300. Again, another provision is to be created 1540 for legal expenses. Again, to provision. Land is appreciated by 20%. So what will be the entry? It will be land account debit to memorandum revaluation account. So here it will come on the credit side. Buy land 10,000 because it is 20% of 50,000, which is 10,000. Okay, that's it with the revaluation. Now we have to balance the account and find out what is the profit or loss or revaluation. The profit and loss and revaluation is here on the credit side it is 10,000. On the debit side it is 2,800. So again 7,200 is your profit on account of revaluation. So this profit on account of revaluation will be shared among the existing partners in their old profit sharing ratio because all these assets and liabilities were there in the business before this retirement. So all are three of them are equally responsible for the profit or loss on account of these revaluation of assets. And hence it will be shared among all the partners in the old profit sharing ratio. Okay. So with this, generally our work will be completed. But in the question, it is stated that no, you should not show the assets in the revalued figures. Show them in their original value itself. So we need to reverse. So what we will do is we will reverse the entries. Stock, here it was debited, just reverse the entries. Provision 300, provision for legal expenses, whatever you have debited, give a credit to that. Land was credited, give a debit to that. Okay, then you will get the same difference, 7,200. Now the 7,200, earlier what we did, we divided in the old profit sharing ratio. Now you have to divide it in the new profit sharing ratio. Okay, so what is the impact? New ratio minus old ratio is your gaining ratio. So the impact is that in the gaining ratio, A and C will compensate B through the capital account. So no revaluation of assets is done. Whatever is the revaluation profit or loss, it gets adjusted through the capital accounts. Okay, so this is how this has to be approached. So the first part will be in the old profit sharing ratio and then reverse all the entries and divide the profit or loss in the new profit sharing ratio among the capital accounts. And then we come to the last step, which is capital account and then balance sheet preparation. So capital account, particulars A, B, and C. Bringing down the capital. Okay. Then we have to adjust for goodwill, which is 7,200 in B's account. And in A, it is 5850 and 1350. Then we have revaluation. Revaluation profit, it gets divided first in the whole profit sharing ratio. Okay. Then here also memorandum revaluation account. $1,500 and 2,700. Okay. So we don't have any other entries to be made. That's all. Goodwill adjustment, revaluation adjustment. There is no reserve adjustment to be made. So we can close the account. But while closing, they have told the entire capital of the firm, of the newly constituted firm, is 56,000 between A and C in the proportion of 5:3. So the total capital that has to be maintained should be 56,000 and it should be in the ratio of 5:3. So now we'll just balance the account and see if the uh, condition is getting satisfied. So for B, the amount will be paid through bank. Whatever is the amount that is payable, 39,600 needs to be paid through bank. And for A and C, what is the balancing figure? Total comes to 5,400. We need 56,000 in proportion of in a 5:3 proportion. Okay, let me see how much bank balance is there. Bank balance is only 11,000. So we will not be able to pay the entire amount of B, because for B we need to pay 39,600. The bank balance is only 11,000. So we will keep it as a loan because we will not be able to pay it fully. We'll keep it as B loan as of now. And 56,000 in the ratio of 5:8. This is for A and this is for C. 56,000 in the ratio of 3/8. So this is the capital that is required. So balance should be 35,000 and 21,000 over here. So both of them need to bring in certain amount by through bank. 2,150 and 3,450. Okay, this is your balancing figure. So we saw that the amount in the bank was less, so I have kept it as a loan. And then there is a condition that the balance should be 56,000 should be the balance in the capital account in the ratio of 5:3. So I am putting the whatever is the balance that is required, that balance I am bringing in the capital account. So the balancing figure will be the additional amount that the partners A and C will have to bring in to meet the condition. So with this, capital account is over. And then the last step, which is step 7, is preparing your balance sheet. Capital A and C is going to be 35,000, 21,000. B loan 39,600. Creditors 19,800, same as in the question. Then we come to the asset side. Land and building, plant and machinery. So we have land at 50,000. Plant and machinery 17. Stock is 16. Stock is 16,000. Debtors 9,800. So I'm taking the same figures. There is no change. Just keeping the figures as such in the previous balance sheet. Cash. So now cash at bank, we have 11,000 plus the amount that has to be brought in by A and C, which is 2150 and 3450. This particular balancing figure, which they have to bring in through bank. Creditors is 13,800. Okay. Yeah. So with this, our balance sheet gets tallied. So whenever you are approaching partnership accounting, try to approach it in this manner, step by step, so that you don't forget any steps, you don't miss out any steps, you are able to cover all the adjustment given in the question, and your balance sheet tallies in the first attempt itself, because this itself takes about 20 minutes to prepare all the ledgers and then arrive at the balance sheet. So at the time when you arrive at the balance sheet, if there is a mistake, it does not tally, you will waste a lot of time in your exam. So go step by step and cover each steps so that you don't miss out any pointers, and the balance sheet tallies in the first attempt itself. So all the best for your exams. Keep preparing. Do share your comments in the comment box, and if you want us to take up any specific questions, you can share it as well. We have a Telegram group, so you can, that link is also given in the description. You can join the Telegram group where we will be sharing these Excel workings. Thank you so much.